We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Drew Rathgeber from ProGoldTrader.com. Drew, how are you today?
I'm doing well. And yourself, Tom?
I'm excellent. It's great to have you back. And, this is going to be a discussion today on kind of the issues that you have seen in the gold and silver industry. You are a seasoned veteran of the gold and silver industry. You've got a lot of stories to kind of illustrate a lot of these points that we're going to bring up today. So, in my time doing the show, there has been a small handful of people that I've really come to kind of trust. And that's only been through building these relationships with a couple of you guys and understanding, motivations, different licensing requirements, all of these different things within the industry. And, I think the biggest part about gold and silver that most people want out of it is creating a really high trust environment. That's not something that we necessarily get with every single dealer or person that is involved within the industry. So today's discussion is based around kind of some of the problems, highlighting some of those issues, and just really explaining a lot of the ins and outs of the industry. This isn't to kind of like tar everybody with a black brush, but there are definitely problems within this industry. So why don't we kind of start by talking a little bit about the state of the gold and silver industry right now, and kind of a little bit about your history within it as well.
Well, let's start with my history. I got my start in Newport Beach, California, at one of the nation's largest spot bullion dealers, and that was my introduction over 20 years ago, where I learned more about the spot industry, and and learned about how people perceive the spot market and their target markets and so on. And in 2006, I transitioned over to the future side and kept really studying the precious metals markets as a whole, trying to understand who wins, who loses, who's really benefiting. And, always asking myself, where's the trade? Where's the trade at? And so really I was a gold bug at the very beginning, just trying to understand where the trade is. And then from there, getting into the futures really taught me the other side of the equation, more sophistication, the licensing, and the regulatory framework that I now work under, which is a very strict regulatory framework from the CFTC/NFA, and background checks and audits. And then a couple of years ago, I started my own firm, Pro Futures Trader and ProGoldTrader.com. And ProGoldTrader.com is really the education arm of where I'm trying to get my story out and educate people on the current state of where the precious metals markets are, from really a regulatory landscape, and in choosing my biggest thing is just choosing the correct instrument and showing people how the spot industry works. Not all of them, but many spot dealers, particularly the bigger ones, take advantage of elderly folks with these spot storage accounts and excessive spreads. And that's really what I'm trying to do, is get that story out and teach people, how to protect themselves and who to trust within the industry.
So I think the biggest piece that you mentioned there that I think, most people don't think about is this idea of regulation. This industry by and large is actually unregulated. So why are there differences between some dealers not necessarily needing to or adhering to any type of regulation versus you having to be regulated, having background checks?
Yeah.
Where's the difference?
The spot industry, I guess, the Dodd-Frank Act came out in 2010 and added some additional regulations on the spot industry. And I will be honest with you, if you the CFTC has really gone after a lot of spot dealers and made them change their ways because it was a lot worse. Let me give you a case in point. Monex had a leverage arm of financing precious metals. So the CFTC just fined them recently about $38 million. And there was, I think, in excess of $450 million in client losses in that program, called the Atlas program. So the CFTC is trying to wrangle it in, but Congress really hasn't created enough rules to fully wrangle in the spot markets and the many different schemes that they do. They just kind of alter course and change their ways. They got rid of the Atlas, but they're still doing the rare pneumatics and the high spread charges, effectively just transferring your wealth to the spot dealer. Now, on the regulated side, we're regulated. I'm not a big fan of regulations in one aspect, but I see the point of them. Particularly on our side, there's a lot. Yeah, in certain cases, when I first got into the industry, I was very conservative. I hate, don't want the government in my business, and let me just do what I need to do. But I'm starting to understand, particularly with social media, and there's a lot of influencers and a lot of things taking place, that we do need some regulation. And even with AI, when Elon first came out and said, we're going to have to regulate AI, I really didn't understand what that meant. And now I'm starting to understand why we need to regulate some things to protect the general public, because you really can brainwash people with the internet. And so in saying that, now that I'm on the regulated side, there's just a different level of professionalism, consumer protections put in place, point blank. Let me give you an example. I was on the phone with an elderly lady probably about 2 months ago. She was a gold bug. She knew Jim Sinclair. She knew all the players in the industry, but she disclosed enough information where I would never be able to open up her account. She retired, wanted to do the minimum, and husband died, and no other source of income. So there's consumer protections put in place where I have to deny that account. Now in the spot market, they'll take her, absolutely to the cleaners. So there's good and bad, with both sides, but I do understand why we do need regulations. Like, before the CFTC was created, it was like the Wild Wild West, from my understanding. I wasn't alive then, but, people were selling, pieces of wood, calling it a piece of gold, or ships off the coast with oil in it and selling that supposedly, but there was no oil. So there's a higher level of checks and balances on the regulated side. I mean, they audit the vaults, they audit us, we record everything. Every T is crossed and every I is dotted on the regulated side.
So is this almost akin to being like a fiduciary and non-fiduciary advisor?
No, actually, within the CFTC world, there is no fiduciary per se. It's not like the stock market where we have a fiduciary responsibility or there's a rule in the rule book, but there is a KYC, know your customer rule, to where we have to basically have morals and ethics. And it's written straight in the rule book, with the NFA rule book, that we have to treat everybody in their best interest. Okay. We cannot persuade people based on the information they share with us and do it that's beneficial to us. Things like churning, or, things like putting people in riskier trades than maybe they're comfortable with. We really have to get to know each individual customer and then place those trades accordingly, make sure. And really the biggest thing, education, make sure they understand what they're doing, because there is one big Achilles heels with futures, and that is the leverage ratio, And if you master that, you can really start taking advantage of futures and use no leverage at all. That's the interesting thing. Futures has such a horrible name because, in my opinion, they do offer too low of margin requirements when it comes to leverage. 5, 6, 7% down on a contract is ridiculous. But I would teach that person and say, hey, you can do 50% or go fully paid and still take advantage of the cost effectiveness of futures.
Right. Which I think we'll get into in a little bit. But, Drew, I want to ask how your time in the industry has really changed. You said you started over 20 years ago, and that was, really before the internet had as much of an influence, as much of an impact as it does now. So, you've seen the rise of certain personalities within the precious metals industry. I'm sure there's good and bad. So if you can, tell us a little bit about the change that has taken place within the industry with the rise and the accessibility of really a larger client base to certain quote unquote influencers.
Yeah, the social media influencers become, there's good and there's bad. Like I noticed on your show that you have a lot of really good people. Okay, I'll start off with that. And you vet your
I
people.
do my best. I do my best to try to have,
Yeah.
You and I were having this discussion the other day about, sorry to interrupt, Drew, but
go ahead.
This idea of trying to be non-sensational and making rational decisions. I don't want people to make decisions based out of fear. There's a difference between trying to understand the world objectively and not trying to have a fear-based approach to selling metal or selling any service of any type. And, for myself, that's something I take as seriously as I can, especially, I'm not saying I've been perfect at that. I've learned a lot through my time doing the show, but that's something that I take very seriously, trying to be a good steward of the industry as, a handful of us really try to keep in perspective as we're trying to provide information.
Yeah, I mean, and I've noticed that, and I appreciate what you said. That the key word there, you said objective, and the other key factor is there's two things. A lot of these social media influencers and spot dealers, for that matter, there's two things called fear and greed, and that is the marketing motto of a lot of these guys. The world is ending. The world's going to fall apart. You better run. And so it's a fear-based investment, right? And that's how they get a lot of these folks into these transactions. And what I'm trying to do, like you, is make it as objective as possible. Like sit back, breathe, and say, okay, what is the best instrument? What is the best strategy? Let's have a real conversation about each individual client's needs and wants and place their trades accordingly. But getting back to the social media influencers, it is exploded in the last 5 years. I would say when I first came into the business, I'll never forget, I Googled bullion dealers, and I think 4 popped up. There were a lot of players and a lot of market reach. And then the social media influencers with an X or Twitter, Discord, there's just a lot of things that licensed people could never say or do. So there's a lot of what I want to say, like, cherry picking. So people will get on the internet and try to influence the precious metals markets and say, look at my one trade, look how I just made, $30,000, but it doesn't really give the whole picture. That act, if you're a licensed individual, if I were to say something like that, I would be censured and fined. Okay. Because it doesn't give the whole picture. I always tell people, show me your 1099 at the end of the year. I don't care about your one trade. And a lot of people on the internet really promote their one trade, whether it's real or not. There's still a lot of fraud because we can't verify it. And then they sell their newsletter alongside of it, or they can even do different things. I've got an ex-client, has been a client for a long time. Bo Poloni is a big influencer, over 120 million views. He was a client of mine for over a decade. And I got to be honest with you, he'll put out, 100 predictions. And if 1 or 2 are correct, he'll cherry pick those and promote them. And that is basically fraud with these guys. And it's a frustrating factor. And I know we talked about Coleman saying the same thing with me. I protect a lot of my clients from those people. I'll divert them away and say, no. They may get it right once or twice, but let's step back. And the other key issue is risk management, with these trades. But getting back to social media influencer, it's become pretty problematic. There's more and more of them coming out. Everybody, I noticed through COVID, a lot of work from home people, they're starting a little side gig and they're creating these new little newsletters where they're charging for, market advice. And, really, if you came to me, I don't charge for any market advice or any professional advice. I charge nothing. I make a small commission on my trades, but I charge nothing. And, I don't have the crystal ball. And in my opinion, no one has the crystal ball, but the way you manage a trade is really a lot to do with risk management. Not necessarily the direction. It's just really how you place that trade and what you're looking at, So,
Drew, if we could, let's get into some of, let's say your history at Monex and why they were fined, and let's say the structure of that type of program and the issues with that.
So they had this program. It's still called the Atlas. And effectively, it was a gimmick. It took me, I worked there for just over a year. Once I did the math, I figured out that after 8 or 9 trades, effectively, I was just an equity raiser for the Carabini family, the owners of Monex. And it was just a real sneaky, and that's the thing. There's a lot of sneaky things where they lack transparency. And effectively, they were 4X in the spreads by offering financing. So effectively just kind of like reselling futures. They were kind of following the futures business model, but then adding all these fees, storage fees, financing charges, spread charges, where the likelihood of you ever making money was extremely low. I mean, I couldn't believe recently they got sued and they took it to the Supreme Court. But in saying that, they had over 10,000 customers lose over $450 million. So it's astonishing to me. So I always think about their number one product was silver. And I remember working on the floor. The number one product was silver. And I always think, what would the silver price look like today if that was all properly placed into the futures market, that 450 million? Would we be at $45 or $50 silver? Okay. Mm-hmm. And a lot of people complain that the silver market is depressed, but realize one of the largest players in the silver market was knocked out and they had to get rid of that financing arm. They're still in business and doing fully paid stuff now. But in saying that, that was huge, in our industry. And I can't confirm that's not why silver's not back at 55, but I think it's one factor why silver's been suppressed.
Mm-hmm. But Drew, let's be a little bit more specific. Like, how were they really generating that revenue? Where did it come from? And what is the structure of that type of program that you have an issue with?
So effectively, it was the financing portion of it. So effectively, they would specifically target unsophisticated money. We used to call it couch potato money, daytime television, CNN headline news, and specifically target unsophisticated investors. Okay. They wouldn't be marketing on the more sophisticated channels. And effectively, it was a financing instrument where, let's say you bought $20,000 worth of silver. Well, you could put down $3,000 and then they would give you a loan for the other $17,000. Okay. And so it was a form of leverage that the likelihood of you ever making money was like almost, probably less than 5%. And they didn't disclose that to their customers. It was just a wealth transfer mechanism to the owners. That's all it really was. And I've known about it for 20 years. I just couldn't really discuss it until the CFTC finally opened them up and proved what I already knew. Mm.
So really, it's just a bundle of fees on top of these trades that ends up eating into any possible profit if you were to make it, right?
Yeah, absolutely. So. And if you did make it, realize that floor at the time was an interesting floor to work on. You had 40 or 50 guys. They're all commission based. And so that's the thing with any of these unlicensed account executives, their goals and the client's goals are not in line. Okay. Because they're working off of commissions. And it's a very tight rope that you're on. And so you're constantly trying to trade your clients, whether they're winning or losing on a regular basis to get that paycheck, So very interesting floor to work on, nonetheless. A lot of criminals. So,
what do you mean by criminals? Like, do you think that was, outright? That was their outright purpose? Were they mostly unknowingly being criminals? Like
no, not like that in that context. Not just actually, they're not required to do an FBI background check. And I remember when I quit, I asked 2 guys to come with me to the professional side. And I was there just a little over a year, and I asked 2 guys to come with me. They both looked at me and said, "I can't. I have a criminal background." And then that's when I realized the spot market is filled with a lot of criminals because there's no required background checks versus my side of the fence where I've been for the last 18 years or so. It's required FBI background checks. Just that one simple factor of when you're investing, I think everybody should be working with a person that's been through an FBI background check. Mm-hmm. Especially your retirement funds.
So does this really only apply to a futures type of trade or these unallocated, quote unquote, digital programs? do you think that extends into that realm as well?
The digital side, I know that they just passed a bill recently. I can't comment on the digital, the crypto side. I know they're trying to wrangle it in. There was just a bill, I think it's called Fit 21. Is that what you're talking about? Like the crypto space?
No, I'm focused on the metals here,
Okay.
but more so like, you have an unallocated metals program where, let's say you're putting in $100 a month or something like that, and you're owning fractions of a bar or some type of pooled account. That's what I mean by a digital program rather than a physical storage program where you're buying individual bars once you have enough capital to buy the entire thing. That's it.
Yeah, I've noticed actually there's a couple firms I've noticed on Facebook. There's a couple firms selling these fractional programs. Again, regulatory wise, there's no FBI background checks, or they're loosely regulated, or they're not regulated at all because that is in the spot industry. I've also noticed that, and it's really not investing. Just like anything in the spot where you're playing the premium game, you're playing and you're trading in that environment, you're really not investing. You're really a collector at that point in time. But I've noticed recently there's a lot of new subscription models where they're selling these very small accounts, and they're really going after subscription fees. And again, you're not investing in that dynamic. You're really just a collector, and you probably will never make any money because the fee structure is just too high on those unallocated fractional shares. I have noticed those pop up recently.
So is that one of, let's say, the biggest red flags we can look for as investors or speculators in this industry, in this side of things, is the fee structure and trying to understand what each trade actually costs you versus trying to look at anything else that can give you clues to what the particular motivation of any of these programs could be?
Yeah, you really, transparency is the biggest thing. And, the fee structure is really what you got to dig into. You got to really, like, I've read every bullion's contract out there, and, you really got to focus in on that fee structure. And even though it may not sound like a lot at first, and you're thinking, 1.5%, who cares? Well, you got to look at that in repetition. If that's like a spot, fractional, if you're trading in it on a consistent basis, and realize not everyone's going to trade on a consistent basis, but they're looking for the people who will trade on a consistent basis. And this is just my opinion. Gold has moved pretty good this year. Okay. This has been an exceptional year for gold. But, if you go back a few years ago, gold only went up 5%, down 5% in a year. So that fee structure, if we go into a sideways churn, and it just sits there for a couple of years, those fees really going to add up. And that's really what I'm trying to get people to focus on, is that fee structure. Really dig down deep and look at your fees. And that's where, like, on my side of the fence, it's fully disclosed. Every dollar is counted for. Everything is shown to you right there on the statement. There's a lot more transparency on the futures side of the equation. It's not really, I don't make any money off spread charges. Okay. My fee is fully disclosed of exactly what I make. So versus in the spot side, it's mostly spread charges, and those can vary tremendously from one product to another as well. So you may start off with a bullion product, and the account executive talks you into a rare nomadic with a 10% spread, and next thing you know, you're done. So
what place do you think the futures really serve for the investor or speculator that wants to, what is the purpose of the futures contract for, let's say, the average person that's interested in this?
See, that's things we're a little bit more complicated on our sites. For the average person, you've got a learning curve that you have to really go through. And that's where we lose a lot of people. You start saying things like first notice or delivery date, or you see the price is a little different going further out. That's where you lose a lot of people because of the complexity within futures. But one of the most astonishing things to me is, gold bugs are truth seekers, and they're constantly on the internet looking for the truth to dig deeper. And I'm surprised most of them don't dig deeper on choosing the absolute best instrument to invest or trade with. They easily get manipulated into these other products. And so I will say futures has an educational or a complexity problem, and a marketing problem for that matter. But saying that, it's where if you really dig deeper, it's where the professional people are allocating their funds to invest in precious metals, just because of simply the cost effectiveness, transparency, use FCM. I mean, there's so many things. I can't go into all of it, but there's a lot of consumer protections and regulations. So, you can really see everything that you're doing on the future side. And I'm not here to say futures is for everyone. It's not, but in saying that, a lot of those storage accounts, a lot of those funds in those storage accounts should be in futures, in my opinion. And you can go fully paid,
So yeah, that's the other piece of it is the leverage. We didn't really touch on that. So what are some of the leverage requirements? What are some of the problems with that?
So there is a problem with that. You can use a tremendous amount of leverage, and I don't recommend using the maximum leverage ever. But in saying that, if let's say hypothetically you have a 50,000, you're going to invest 50,000 in precious metals. You can put up 25,000 and still control that 50,000 and keep the other 25,000 at homes and still give you that exposure without tying up so much capital. I'm actually surprised more gold bugs don't learn that. You can get a little bit more exposure, but in saying that, you're going to amplify your losses, you're going to amplify your gains. So there's added risk whenever you use leverage, period. Okay. So you got to make sure you're comfortable with it. But, what's interesting, I was just thinking about this morning, the word leverage scares a lot of people, but, in the housing industry, which I will say, put a little disclaimer, housing doesn't move or as volatile as precious metals can be. But, everybody uses leverage in home buying, 20% down or 5% down or 10% down. It's the same philosophy, but there's no loans in the future side. So again, leverage can be good and bad. You've got to be very comfortable and really learn the leverage ratio. I even wrote an article on my on ProGoldTrader.com explaining the leverage, and I made a pyramid risk pyramid thing to kind of show you what maximum and what the least amount of risk you can basically do when you're trading using leverage. And one of the things, as an owner is I have to make sure you understand, what leverage is. I even created a video on it. So I would say that's one of the Achilles heel, but there's also, leverage can be great. You don't have to put up as much capital, and you can, if you're truly a gold, you think it's going to take off, you can add a little bit. But in saying that, the Achilles heel with futures is, 5, 6, 7% down is just absolutely insanity, on a market that will move 4 or 5% a day. So effectively, you can lose your entire account on a 4 or 5% move if you put 5% down.
Right.
Don't recommend that. So,
so Drew, if we could, I want to kind of approach this question a different way. Like, what is the point for people that are trading futures? For the average person, let's say they're going to buy 25 to 100 ounces of gold to, quote unquote, secure or use as a savings account. But, that to me is let's say one of the highest trust places to be, because you have hopefully no counterparty risk inherent in that vehicle, let's say. So what is the point for somebody that's interested in this space to get into futures instead of buying physical metal?
I'm not against physical delivery at all. And actually, I promote it in a lot of ways. And that's a good thing. And it's the most conservative way of going about it. But from an investment perspective, and I'm talking your 401ks, IRAs, or higher dollar values. I'm not going to use your example, but just higher dollar values. Take-home delivery is just not really the best vehicle in those situations. That's where you would want to use a futures account. There's counterparty, there's risk with everything. There's counterparty risk with there's actually, in my opinion, there's more counterparty risk with your spot storage accounts. But if you want to remove that, let me get back to your point. If you want to remove that, just take it home for home delivery. Nothing wrong with that. And I actually encourage that for a lot of people for, shit hits the fan situation. But from an investor or investment perspective, it's not the most efficient way of investing. Just because when you take home for delivery, and I see this a lot, the spreads can vary tremendously. Somebody within 3 years wants to turn that back into cash. And then they realize, I always tell people, the most important part of a transaction is not where or who you buy it from, but who you sell it back to and for how much. And I can't tell you how important that is. And that will complete the transaction. And particularly when you do take home delivery, and I always promote only investment grade products, completely stay away from the aromatics.
Mm-hmm.
That is where the spreads are the highest, and that's where it could take years to recoup your spread charges. But when it comes to take-home delivery, just straight investment grade, circulated coins, the BNFL Harmonics, the American Eagles, the popular brands.
Mm-hmm.
Those are easily transferable, and stay away from the aromatics.
Mm-hmm.
But for investment purposes, where you're really talking bigger sums, that's where the kind of the futures instrument comes into play. That literally beats a lot of the other instruments out of the water.
So is it possible to take physical delivery at the end of a contract, or can you keep rolling that forward if you're comfortable with that trade?
Yeah, so I have a lot of clients. I've taken personal, or not personally me, but I've had clients take delivery.
Mm-hmm.
Now, in saying that, only it's really for larger dollar values.
Yep.
It's the full size contract. It's not the micros, the minis, none of that. So really, it's designed for really the institutional high end. I even had a client out of Wyoming that took 750,000 silver out of COMEX, and it was an interesting process going through the whole. It was actually pretty simple. You get brinks, you bring it to the vault, and they take it. And as my client said, I've got more silver here than I know what to do with. But you can, and he saved a tremendous amount by doing it that way. But really, delivery in the futures is for high net worth individuals. Okay, but you can take advantage of the that spread charge, as well. Within the futures landscape.
So, give us a real world example, let's say, of spread charges. For those that might not understand what we're talking about by the term spread. What is the give us an example of that, please?
So let me give you an example. Spread. It's funny. They use a lot of convoluted words. I kind of think it's pretty smart and kind of sneaky at the same time. But spread charge is a hidden cost of doing business. Okay, and spot dealers make money on the spread part of it. Now, for me personally, I don't make any money on spread charges. We just get the exchange spread. But in the spot industry, you have these astronomical spreads where you can. The bid ask, the difference between a bid and an ask, okay? And it can be $30, it could be $60, it could be $90. That's how much you're losing per troy ounce on the transaction, okay? And so in a spread or in a spot transaction, particularly in the spot storage accounts, if you're losing $60, let's say hypothetically you're losing $60 on per transaction. You do 10 transactions, you're going to be down $600 per troy ounce. So if gold's at 2,600 and we stay here for the next year at 2,600 and you do 10 trades in that account, you're going to be down to $2,000. And that 600 will have gone to the spot bullion dealer. And it's astronomical when you look at it. When you compare like a futures contract, we're talking cents, 10, 20, 30, 40 cents. So the disparity is absolutely off the charts extreme in terms of cost effectiveness. And that's really how the spread charges work. It's the difference between bid ask, and it's a hidden charge. And in my opinion, especially these spot storage accounts, it's kind of theft, and because it's not fully disclosed. I think some spot dealers disclose it on their statements, but they don't have to. They just take it out of your equity or account, and it just slowly comes out.
Yeah. And again, I think obviously, there's a portion of the audience that's going to understand this. There's a portion of the audience that might not understand this. So let's say the spot price is at $2,000. You're probably going to pay $2,050.
Correct.
To actually get an ounce, right?
Correct.
And then when you go to sell that back, let's say the spot price is now at $2,500, but the offer that you're going to get to buy that back is, let's just call it $2,400. So there's a $150 spread there that you're going to lose right off the top on each ounce. So that's the spread that we're talking about. So
that is the spread.
So then when we're thinking about futures contracts, is that spread much tighter?
Significantly. That's really where it's night and day. The spreads can vary. I got to put a disclaimer. Spreads can vary at one point in time based on liquidity and market conditions. But in saying that, my clients we're getting 10, 20, 30, 40, maybe 50 cent spreads. This is cents, not 60, 70, 80, $90 spreads. Same with silver; it can be as low as half a penny. But you might get a 1, 2, 3 cent spread in the silver market. So the disparity between ProGoldTrader and these spot in the spot market is just astronomical, and that's where a lot of And the interesting thing I always think of, the point of investing in precious metals, we're all marketed to as, wealth preservation, hedge against inflation. And my attitude is, well, what about hedge against the spot dealer? Because their charges can add up so much if you do multiple transactions within that storage account.
Mm-hmm. So typically we're talking about different time frames, correct?
Mm-hmm.
Inherent. I think we should acknowledge that what we're speaking about when we're thinking about, let's say, the gold price going from $2,000 an ounce to $2,500 an ounce. If you're thinking about that as a physical transaction, you're going to be holding that for let's just say a year typically,
mm-hmm.
but you're still going to pay that spread. With a futures contract, are you not, kind of inherently talking about a shorter time frame?
And what do you mean by that? As far as, yes, I mean, you're going to have to roll the contract to make it a continuous.
Mm-hmm.
Now, as far as you can make it continuous just by simply rolling the contract from 1 month to the next. And we have 3 to 4 rolls that you can basically participate in per year and to make that continuous.
Mm-hmm.
Now, on the spot side, you're effectively just going to be, there's no roll or transaction with that. Okay. You're just sitting on that precious metals. But yes, there is a shorter time frame per se because of the first notice and roll, but we only have, like I said, 3 to 4 rolls. And I've got some clients that go out 6 months just to avoid rolls. They fully understand kind of how it works. And they're like, I'll just go out 6 months. And so they just roll twice a year, and invest in that way. And so there is a shorter time frame within the futures. And that's where we do lose some people just because of that complexity, it is more complex,
mm-hmm.
When you start talking about rolls and expirations and first notice.
Right. So, Drew, does this really apply to only, let's say, futures versus physical, or are there also problems with, IRAs, Roth IRAs, 401k type programs? Like, what are the ins and outs of those particular accounts?
So right now, the Roth or the IRA, I would say elderly folks are very, fear-driven kind of people. Let me give you an example. My mother's got dementia. If a dealer got a hold of her right now, it'd be easily to get her. But the Roth IRAs are being specifically targeted by a lot of these spot dealers, and they're using basically the wrong instrument. So there is different ways of going about with your investment or I'm sorry, not your investment, but your retirement funds.
Mm-hmm.
And again, this is where the regulations really come into focus with those retirement accounts. I mean, that's hard-earned money for a lot of people. That's their retirement money. And that's really where you want to work with a licensed individual and have some of those safeguards, those consumer protections put in place when you're investing your retirement funds into precious metals. Actually, there's another bullion shop in California. I think they went out of business, called Oxford, but they were targeting retirement funds. I'm not going to get into all the details, but really it's one of my sticking points, as a licensed individual, that retired folks and retirement funds should really be focused with a licensed person, just because there's so much more consumer protections, honesty and transparency,
mm-hmm.
So
are there any other, let's say, big problems that you've witnessed over the years that are costing clients a lot of money, other than, these higher fees and or these spot spreads?
Really, it's the spot spreads. These storage accounts. The Monexes of the world, and these. That's really where I see a lot of people losing a lot, and I just always wonder what the price of gold would really be, or silver for that matter, if it was applied in the correct instrument. So I guess I've just been beating the same drum as the instrument and having the sharpest weapon, and understanding the difference between, like I said, delivery is fine, but the spreads is really where people are getting hammered. And it's interesting. I think the Europeans are much more savvy when it comes to spreads, but the American population does not come across as savvy. You say the word spreading, you lose them.
Mhm.
And I think that's one of the things I'm trying to educate people on is really digging deeper and understanding that spread charge and not just trusting someone. Like I said, I just had a client invest with a bullion dealer in Colorado. And I said, hey, what was that? Sent him 50 grand. I taught him what it was. And he wrote me an email back and said 8%. I just couldn't believe it. 8% spread on one transaction,
Mhm.
So you really got to dig into that and just realize that it can add up over time.
So then if you're getting in and out of that trade, let's say 10 to 12 times per year, that ends up adding up to basically your entire principal.
That is correct. That's their goal.
With an 8% spread. Yeah.
Yep. And that is their goal.
Mm-hmm.
So that's what happens is with these spread charges, and it could be even 3%, 4%, doesn't matter what their goal is, to get you to do 10, 12, 13 transactions. And next thing you know, your money has now been transferred to the bullion dealer. And I guess that's the whole purpose of me starting ProGoldTrader.com is to really, my philosophy was, I see a huge problem and I wanted to educate people and start trying to protect people from just a moral perspective and teach them how this stuff really works and how they're losing tremendously on these sneaky spreads,
So are there any other particular stories that you think illustrate the difference between a licensed and unlicensed broker or person that you're dealing with, and or maybe a high net worth individual that ended up losing a lot of money because they weren't aware of a lot of these ins and outs?
Yeah, I mean, let me be honest with you. I'm on the phone with people all across the country, all gold bugs like you and I, and the general public. So I get a good temperature check on their intelligence on investing and whatnot. But I will say I had to bring up one story. I had this guy Pearlstein out of California, and he had an account at Monex. I warned him. I sent him all these emails to show them exactly how it worked. And unfortunately, the complexity was just too complex for him to understand. And I probably knew too much. In terms of I was trying to explain it to him, and they used high pressure sales tactics. They put the fear of God in this guy, and he was just completely petrified. And I'll never forget. He called me back 3 months later. He lost everything, and I said, I knew it would happen. And I get that a lot with my clients. They'll go off into different instruments and whatnot, and I'll teach them, and they may give it a shot, and then they come back. Oh, I should have listened to you. Because I know exactly how this stuff works from the inside out. So that's one story. The Pearlstein, he got completely blown up over there at Monex. And, I hear that. I'm not going to say a lot, but that's just kind of the state of the industry. And that's the part of the industry that just makes me want to kind of jump up and scream for everybody and try to help them out.
Well, and I think it's kind of symptomatic of the industry as a whole, paying attention to a lot of the stories that I don't think get a lot of press over the last couple of years are, some of these storage programs, the Monex story. There's some of these stories that, again, aren't very well known, aren't very highlighted, but they're highlighting a massive amount of fraud and massive fines that end up being paid out, which in turn means, a disproportionate amount of client money that ends up being lost. And, I think unfortunately, again, to kind of reiterate that, it's not very well known. There's I can think of 4 or 5 big lawsuits over the last year within the gold industry against these, whatever type of storage program it was, that highlight the amount of losses by average people. So I think understanding this stuff is really key.
Yeah, it is. And I agree with you 100%. I'm surprised these stories don't get out more or are publicized more or talked about really. I would say as insiders, you and I or Coleman or other people we talk to, we all scratch our heads. I mean, even when I went through my audit, they knew, where I came from, what it was, and the regulators, oh yeah, we know them, but as far as the general public, it's interesting. You're right. There's not a lot of what's the word I want to say? There's just not a lot of education on this stuff, and it's not in the headlines like you think it would be. I think right now, like I just saw recently in California, there was a lot of news. I was on the Channel 7 news of one of these bullion shops, and I think it's coming out more and more. But yeah, still to this day, it's just not really common knowledge. And I guess that's what I'm trying to do, is make it a little bit. And that's why I'm discussing this stuff and getting my story out, is to try to educate people and make it more common knowledge. I mean, part of this process is talking to you and get that story out to help, hopefully, help some people out.
So, Drew, you mentioned earlier that there was a lady that came to you, and I think what's the right way to put this? Almost disqualified herself from being able to have a futures trading account. So what are some of the guidelines or reasons that was the case?
So we have, in the application process, we're going to ask them financial questions. Everybody thinks we're trying to size you up, and that's not the case. So there's some KYC things we have to have in place, with retired folks. There's some financial questions, and she failed those. I mean, she wanted to invest the bare minimum. She had no job or other source of income. Husband just died, so those were all red flags for me to go ahead and deny that account. And that goes for anyone. If I get a temperature check that this person maybe not understand what they're doing or doesn't know what they're doing, I'll reject that person or client, just because I don't want the risk on my shoulders. But yeah, there's some responsibility we have from the regulatory side to, kind of protect the elderly folks and the people who aren't qualified. Or let's say, for instance, it's a veteran, he's got $5,000, and he's got no job. It doesn't matter the age. We'll still reject that customer. Mm-hmm. We want people, especially with futures, to understand, and especially if they're using a leverage position, that they're using risk capital just because of the inherent risks and the volatility that can be thrown at them. So we just got to be really straight up front and honest with that person. Like, hey, yeah, gold's at all-time highs and everyone's rushing in right now, right? But what if it drops 25% or 20%? It can happen. I mean, look at crude, look at all the commodities. They can be extremely volatile. Mm-hmm. So there's some qualification questions we have based on that to make sure they understand what they're doing and when they're speculating on the markets. And in the spot industry, you just don't have that same qualification. Mm-hmm.
And going back to, let's say, the size, the tradable size of these different contracts. You had mentioned that there's a mini, a micro, and a full contract. So tell us the difference between those.
So effectively, you got I really just trade off the micro and the full size. The mini is a kilobar. Don't really trade off that size, but effectively the micro is the biggest one for like the general public. It's a 10 ounce. It's just, it's 10 ounces of gold. And I mean, at the end of the day, it's so interesting. It's just 10 ounces of gold. And what I mean by that is, an ounce is an ounce is an ounce, and it's been retwisted and repackaged and resold in so many different ways. But with us, it's just 10 ounces of gold. Mm-hmm. All right. So effectively and then you got the 100-ounce contract, which is the higher net worth, individuals. That's a very, very large contract. I'm not going to focus too much on that, but the 10 ounce, and then in silver, you got the 1,000-ounce bar, and then you got the 5,000 silver bar. Mm-hmm. But for today's purposes, you got the 10 ounce, it's just 10 ounces of gold. Okay. And, gold's trading at 2,600. That's $26,000 worth of gold that you can control. And effectively, you can put down $26,000 and use no leverage, or you can put down 10,000, 12,000, 15,000. But please understand that you are increasing or amplifying your losses and your gains. Okay. So that comes with added risks. Mm-hmm. But it's just 10 ounces of gold. And let me give you not to change subject real quick, but another thing too is there are COMEX approved bars. And if you ever see this is another thing. If you ever see in the contract, COMEX or LBMA approved, effectively they're just kind of reselling futures to the general public. And another dealer I just saw recently, the $1.50 spread. So they're charging, $1,500 per silver bar. Okay. And which is astronomical. That was just on the buy side, but that was $1,500. And so with ProGoldTrader.com, you don't have that spread premium game. You're going to get that 2 or 3 cent, whatever it is. You're going to get a significantly lower spread. Mm-hmm. But effectively, you've got the 1,000-ounce bar and you got the 10-ounce bar. To get back to your question.
Yeah. And then if you actually want to take physical delivery, it's only the full contracts that you can, right?
That is correct. So it's just a full size contract. So I would say 99.9999% of my clients do not take delivery. But saying that, you know, you could always, I guess, offset your position and go buy some physical. Let's say hypothetically you have some profits, you use the futures account and you want to take delivery just to offset it and go buy some physical coins and take it home, you know, if you want to do that. So,
Drew, what are some other ways that you manage risk? You know, we've talked about the idea of not using as much leverage as is possible, but what are some of the other ways that you understand and manage risk?
So it's a good question. You know, time and trade. You know, I have some clients where, you know, we kind of pop in and pop out and removes the market risk, removes the volatility risk, and we don't sit in the market all year long. You know, I do a lot of that. You know, I think just sitting in the market, you know, for years and years can add some risk in some capacities. But I manage that risk by sometimes just simply popping out. And this could be in the middle of the night. I mean, that's the thing is, you know, this could be at 9 o'clock at night. You know, we could have an adverse move, or, you know, there could be a market report coming out, and we will manage that risk by just going straight back to cash. Okay. And it takes me, you know, 1 second to go back to cash for a client. There's no calling and mailing your gold or silver. It's just a click. And that goes for the client too. Like they can look at their phone app and managing their risk. The client can look at their phone app and see exactly where their account stands, you know, basically 24 hours a day, and go say and push a button, go back to cash.
Right.
That is one way of managing risk. There's multiple ways, you know, leverage ratios, option plays. Let's say hypothetically, you think you want to protect some downside risk. You can go in and buy some put options. You can do spreads. There's multitude of different ways we can kind of manage risk from, and it's got to be one of the most important things within this industry, to be honest with you, is understanding your risks that you're putting out there, and how are you going to manage that? You know, what are your options?
So, Drew, obviously being, you know, having your finger on the pulse of this industry and what's going on all the time here, are you seeing an increase in clients at this time? You know, we're days away from the Fed announcing what their rate cuts are going to be. Seems like there's a lot of uncertainty within the market. What are you seeing for market and investor behavior at this time?
Yeah, that's a great question, because I work off of investment behavior when I go and give advice to some other clients. Right now, everyone's adding a lot of risk to their accounts on my book. That it's on them. It's self-directed. So realize that too. I don't always give advice. These are people who just trade on their own, or they're fully self-directed. I'm watching the trades execute. There's quite a few of those types of traders. We just call them self-directed traders. Okay. Where I'm not giving advice, but I'm seeing a lot of people adding up and ratcheting up a lot of risk that I personally, I mean, if they're comfortable with it, that's fine. I personally wouldn't be giving advice and trading that way right now, especially going to the Fed meeting. You know, the thing is you got on Twitter and social media, a lot of pumpers saying it's going to skyrocket and go to the moon. I can be a little bit of a contrarian sometimes. It's buy the rumor, sell the news scenario where, you know, it kind of ramped up going into here, and then we get the announcement from the Fed, and then they decide to sell off, you know, 6%, 7%. It's kind of what's lingering on in the back of my head. I can't say it's going to happen that way, but I would definitely be watching your risk right now going into this first interest rate cut we haven't had in years. And if they do it at all, or if they do 50 basis points or 25 basis points, that is that's the question. So there's going to be a lot of volatility.
$1 million question.
Yeah, it's $1 million question. So there's going to be a lot of volatility. So my managed funds, I'm actually kind of out of the metals. We did well, and, you know, we're just kind of sitting on the sidelines. But then a lot of my speculative self-directed guys, they're just ramped up right now, and that concerns me a little bit. So yeah, I can share that sentiment with my clients, and that's the other biggest thing is I do work off of kind of what I see, you know, market sentiment, what's going on in the social media sphere, and when I see everybody to the moon, I go, you know, watch out. So,
and has that rise, let's say, been in the last, like that rise in people piling on risk, has that been, let's say, in the last month?
I would say just last 2 or 3 weeks, like last 2 to 3 weeks. Yeah, just last 2 or 3 weeks. Yeah, that's what's interesting to me too, because here's the other thing. I'm very particular when I put out a trade recommendation or trade, not recommendation, but trade analysis. And I put out, I think it was, you can go to my YouTube channel, but I put out a trade, take a look at silver when we're at 23, 22 and a half, $23 silver. And I was screaming, buy, more or less. And nobody was paying attention, and so we've had a big move in the metals industry, in the metals complex. And I understand that, futures were designed for the hedgers really and the producers. So they're going to run the stops one way or another. So you just got to be really on your toes with the stuff, and that's kind of where I'm a little risk adverse with clients. I miss moves sometimes, but I'm just managing that risk to not to, put them out there. So I don't have the crystal ball, but I sometimes will step aside just to kind of let the markets and volatility is interesting. The general public is so attracted to volatility. And I know this is not going to be a popular opinion, but the general public looks at a chart and they see these spikes. And I'll be honest with you, general public and volatility don't really do too well together. They all get kind of pushed into one corner, and that's the power of the internet right now. And that's the thing I'm learning is AI could be very detrimental because it kind of pushes everybody into a corner. And when I see high volatility, whether I miss the move or not, it's just not worth the risk sometimes, And even if I missed out on something, or FOMO, fear of missing out, which I see a lot of, and I'm seeing a lot of that right now, fear of missing out. I internalize that and say, it's just not worth the risk to chase this thing right now. Mm-hmm. And so I have a saying where, missed money is not lost money. So don't get mad if you miss a move. You're going to miss moves. It's part of the game. Mm-hmm. But it's not lost money.
Yeah.
So
I know that's one lesson that I learned in 2016 in the crypto space.
Yep.
I FOMO'd in big time. It was an expensive lesson for myself, but a very valuable lesson. And, thankfully ended up being about 4 years later, I was able to break even on that trade finally. And again, it's a very important lesson. And that's something that I really look at in myself is when I think, this is just a pile of junk. I want to get rid of this, whatever it is. That's probably the time to be buying. And I've watched my own psychology in that.
Yep.
And really learned from it.
Yep.
And when you think you're super smart and you're going to make all kinds of money from a particular trade, that's probably a great place to try and start at least taking some profits and maybe take your principal off the table, in my experience. Because, man, every time I see my psychology go to one of those extremes, it is absolutely instructive. And I mean, if you keep a trade journal or just a diary of even those sentiments, I think that ends up being extremely instructive over time.
Yeah, I'm extremely analytical, including of myself. Mm-hmm. And so including the markets and my clients, and I can see I'm very analytical. I love psychology. It's kind of what brought me into this. And there's a lot of psychology to this. So I analyze my own emotions and I've taught myself, it's taken, years and years and years, but I've really taught myself when I feel an emotion, maybe that's the time to trade or not to trade, and I've learned to really control that psychology. And like the FOMO feeling is one of them, where I just say nope, mm-hmm. or when no one's paying attention, like no one, a year ago, nobody was paying attention to the metals. No one cared, and I got that market sentiment. And that's when I was like, kind of like, because I felt that, mm-hmm. I was kind of like, well, now's the time, but no one cared, in retrospect, nobody was paying attention. And now we're getting that emotional, and there's a paradigm, there's a graph out there for this, all the emotional cycle that we go through.
Yeah.
And, like right now I'm seeing it, where people are starting to think it's easy, and it's like, it's not that easy, and it's, take some off the table or manage that risk,
Mm-hmm. Absolutely.
So, but it could continue. It could go straight to 2,700. I don't have that crystal ball, and we could go right back and test, I know a lot of people are saying 2,500 is the new floor, but whenever somebody, and that's the other thing too, whenever somebody puts a prediction out there or anything, on the floor, whatever, I just say, it always makes us all look like fools in the long run, and that's why I'm very careful on what I put out there, how I project. And, if I say the floor is 2,500. Next thing you know, we're at 2,200. I mean, this stuff can really move.
Mhm.
So,
Well, and I think that's a very honest admission on your part
Mhm.
that, really nobody has a crystal ball. And that is one thing that I have really learned from doing this show and having thousands of these conversations is
yep.
that nobody is right 100% of the time. I really wish I could point people to somebody that did have that ability.
Yeah.
But, again, this is, I think being in the metals is something that is an investment and or trade that takes time.
Yep.
And hopefully helps you really sleep at night because you understand the fundamentals of being in the metals rather than being driven there because of fear of missing out, because of any type of sensationalism. And again, I appreciate you coming on to help try to educate people on these ideas.
Yeah. I mean, at the end of the day, I really want to I really want to create a new level of understanding and a new level of traders, that really can step up their game. And, I keep on saying, if I can just create a group of elite traders, and we all work together and really, step up everyone's educational level and really from a license perspective, a professionalism perspective, really just create a new standard. I mean, that's really my goal, my vision, and that's what I'm trying to do. So.
Excellent, Drew. Well, is there anything else that you'd like to
Nope.
to leave the audience with before we wrap up?
Nope, that's it. Sorry, that was a phone call if you got that phone
No
at the end of it. But yeah, no, that's it. I think you've got the point. If anybody wants to learn more, go to my ProGoldTrader.com video. I've got a whole educational archive. And if anybody ever has a question about the markets or instruments or anything, I'm always here to talk. So
excellent. And of course, on Twitter as well, at ProGoldTrader _, at the end of it. Drew,
yeah,
thanks so much for your time today.
Actually, my personal one's Metals Hidden. I
Okay.
put that out there because I've always been kind of a hidden guy. So it's at Metals Hidden and then at ProGoldTrader. So I've got two of them, but the Metals Hidden is kind of, I'm just, because I've always been an underground, trader.
Mhm.
So, but
Excellent.
yeah, there as well. All right.
Thanks so much, Drew. Appreciate your time.
All right. Take care. All right. Bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.